Hi, this is Pfeffer-Hahn. I'm going to clarify financial topics and make managing your money less mysterious. So in a world where finances can be intimidating, I'm here to simplify the complex, making personal finance fun while you transform your financial landscape. So let's dive into the world of CDs and MMAs. Understanding the differences between certificates of deposit, or CDs, and money market accounts, MMAs, is important when you're making decisions about where to stash your cash. Starting with CDs, picture them as fixed-term savings buddies. You're going to lock in your money for a set period of time, which can range from a few months to several years. The cool thing? CDs often pay out the highest interest rates compared to regular savings accounts. It's like setting your savings on cruise control and watching it grow. Now, money markets, or MMAs for short, these are a little bit more flexible than CDs. You can dip into these funds when you need to, usually with limited check writing abilities. Plus, they'll offer higher interest rates than your run-of-the-mill savings accounts. But you're not going to get as high a return as you would get with CDs. But let's do some comparisons between the two. So if you're comparing liquidity and commitment, MMAs typically offer greater liquidity compared to CDs. And this means that you can get to your money if you need to, because they allow for those limited check writing abilities and easy access to your funds. While CDs require a commitment to a fixed term, and during that time, if you make any withdrawals, you might incur penalties. The interest rates and potential returns are also different. CDs generally offer higher interest rates compared to the MMAs due to their fixed-term nature. MMAs, while offering competitive rates compared to standard savings accounts, usually yield lower interest rates than CDs. These money market accounts invest in short-term liquid assets, including treasury bills, T-bills, or municipal bonds. Your bank is going to earn interest on these investments and so in effect split the interest with you. CDs, on the other hand, can be a good choice if you're certain you won't need your cash for several months or even years, and you want a consistent rate of return. Typically, a CD is a supplemental account that doesn't replace the need to have a regular savings account for everyday savings. They each have different minimum deposit requirements. CDs often require a larger initial deposit compared to MMAs, which can be opened with a lower initial balance. While many institutions offer CDs with a zero opening balance, the best CD rates can often be found with banks requiring larger deposits ranging from $500 to $10,000. While MMAs might also need a deposit to open, around $1,000 is common. And if you maintain a higher balance, you'll be able to avoid fees. So the risk levels between these both are considered relatively low because CDs are insured by FDIC, the Federal Deposit Insurance Corporation, up to $250,000. While MMAs offer similar insurance either through FDIC or the NCUA, which is the National Credit Union Administration. MMAs interest rates fluctuate based on market conditions and the policies of your bank or financial institution. In contrast, the interest rates on a CD remains fixed for the duration of that term, providing you predictability but limiting the gains if there is a rise in the market. So penalties for early withdrawal. CDs often impose penalties withdrawing funds before the maturity date. And these penalties can vary depending on your bank or financial institution. And the terms of the CD say you have a 2-year CD that has an early withdrawal penalty of 6 months interest. If you cash out your CD after 7 months, you're going to forfeit the interest from the first 6 months and are left with 1 month interest. If you have that same CD with that same 6-month penalty and you withdraw after 3 months, the penalty will actually dip into that principal deposit that you originally made. While MMAs typically allow you more flexibility for withdrawals throughout without penalties. Although certain limitations may apply. In other words, you might pay a closing fee if you close that account earlier than agreed upon length. But generally, the penalties are not as high as CDs. In terms of account access and convenience, MMAs offer additional features such as debit cards, online bill payment options, enhancing accessibility to funds, and that's compared to CDs. And this convenience factor can be particularly beneficial for individuals who require frequent access to those kinds of savings. The interest payments are a little bit different for them as well. CDs typically pay interest either upon maturity when you take the money out or at regular intervals throughout the years. while MMAs offer more frequent interest payments, providing investors with a steady stream of income. They compound daily and are paid out monthly. Making sure that you understand the difference between certificate of deposits, CDs, and money market accounts, MMAs, is crucial for making informed investment decisions. This is Kathy. Thanks for joining me on your journey to financial empowerment. Thanks to all of you who have already subscribed. And if you're new here, please consider subscribing so you'll be able to change the way that you think about your relationship with money.